Hi, this is Jin Choi from Money Geek, and welcome to the 5th episode of the short course on investments. And today we're going to learn about mutual funds. So back in the day, before mutual funds existed, people had a problem. You see, people understood that if they wanted to properly diversify, they understood that they needed to hold tens or even hundreds of stocks, bonds, and other financial securities. But doing that was not practical for the average person. For one thing, it would cost a lot. For example, let's suppose that you had a $5,000 portfolio and you wanted to diversify and buy 100 stocks. Well, buying each of those stocks might cost you $5. But since you had to make 100 transactions, that will cost you $500. That's a tenth of your portfolio. And there's also the matter of choosing your stocks. There are thousands of stocks both in the US and in Canada. So you would have had to figure out how to choose those 100 stocks from a sea of stocks. So faced with this problem, people came up with this brilliant idea. They said, well, why don't we all just pool our money together, and with this pool of money, we'll invest in the various securities. And because the pool of money is larger, it can absorb the transaction costs much better. For example, let's suppose that 100 of us chipped in $5,000 each. So we made a pool of $500,000. And let's say that using this pool, we bought 100 different stocks. And buying each stock might have cost $5 each, just like it was in the last example. So in total, it costs $500 to buy everything. Well, $500 as a percentage of $500,000 is just 0.1%. And the people also said, while we're at it, let's also appoint a professional manager who will scan the investment horizon and pick out the best 100 stocks to invest in. And that, in a nutshell, is how a mutual fund was born. You can buy mutual funds in a couple of different ways. You can buy them using your brokerage account, just like you do with stocks and bonds. Or you can buy them through a financial advisor. In fact, financial advisors actually make a living selling people mutual funds and pocketing the sales commissions. There are many different types of mutual funds. Some of them invest in domestic stocks, so Canadian stocks. Some of them invest in international stocks. Some of them invest in bonds, etc. And mutual funds are pretty liquid investments. So once you redeem a mutual fund, you probably get your money back within 2 or 3 days. So on the surface, mutual funds sound like a great idea. But I personally really don't like most mutual funds that are offered here in Canada. And let me tell you why. The biggest issue I have with mutual funds is cost. So the average stock mutual fund in Canada charges around 2.5% per year. So every year, 2.5% of your money goes towards paying the manager, the buildings, the trading, etc. Now, you don't pay this money directly. Instead, it comes out the top of your performance. So, for example, if the fund would have returned 10% per year without the fees, then that fund would have returned 7.5% per year after the fees. This wouldn't be an issue if the fund managers were so good that they were able to outperform the market by 2.5% per year. However, very, very few managers can actually pull this off. And the reason is that investing is a lot like poker. So whenever someone wins a hand, someone else loses a hand. And in the same way, in investing, every time someone beats the market, someone loses to the market. So by definition, logically, the average fund manager has to perform around the same as the market before the fees. After the fees, the average fund manager underperforms because of the fees. In fact, if you look at the past 10 years, you'll notice that the average Canadian mutual fund underperformed the market by around 2.3% per year. And that's a lot. So if you think back to episode 1 where we talked about compound interest, we talked about how a difference of 2.5% per year over a long period of time can mean a difference of hundreds of thousands of dollars. So in other words, if you stick with the average mutual fund for a long time, it can potentially cost you hundreds of thousands of dollars. But you might say, well, there must be a few managers who can beat the market consistently by more than 2.5% per year, right? Well, yes and no. You see, the problem is most of those managers who probably can consistently beat the market are either already in a hedge fund or they probably will jump into a hedge fund in the not too distant future. So what are hedge funds? Well, this is not a strict definition, but I personally like to think of them as a more expensive kind of mutual fund that's only available to the wealthy. So whereas mutual funds charge 2.5% per year on the assets of the fund, hedge funds charge what is called the 2 and 20. So they charge 2% of the assets every year plus 20% of all profits. And as you can imagine, 20% of profits can be huge. And guess where that money goes? It goes to bonuses. And that's really the reason why people want to leave mutual funds and join hedge funds. It's because hedge funds pay so much better. But for investors, the grass isn't necessarily greener with hedge funds either. And that's because although they might have some smarter people working for them, the fees are just so much greater as well. So once fees are taken into account, most hedge funds don't usually return great returns either. And that's my commentary on mutual funds. And let me summarize it all for you today. We learned that mutual funds are pools of money managed by a professional. And this helps us ordinary investors like you and me diversify very cheaply. And it also gives us access to a professional whose job is to pick and choose investments. However, the current mutual fund fees in Canada are terrible. And because of the fees, most mutual funds in Canada underperform the market, and some of them underperform significantly. And for that reason, I generally dislike mutual funds. And that's it for today. Again, thank you very much for watching. And if you're enjoying this course so far, please consider sharing this video using the share buttons below. In the next video, we'll look at a much better way to diversify cheaply, and that's using index funds and ETFs. So thank you again for watching, and I hope you have a great day.